Hey guys, this is Brandon Ives, and I wanted to go over my thoughts and a couple takeaways from First Republic Bank's failure over the weekend. First Republic Bank was taken over by JP Morgan Chase, 84 offices across 8 states, including $173 billion in of loans and $30 billion in securities. The FDIC, or the Federal Deposit Insurance Corporation, negotiated or oversaw the bidding process, which included multiple banks, but finally ended up with the acquisition with JP Morgan Chase being the acquirer of First Republic. There are three main reasons why First Republic failed. The first, and probably the scariest for many people who lived through the Great Recession in 2008 and 2009, is that First Republic had billions of dollars of unrealized losses coming out of their low interest single family home loans. Now, we need to remember that this is different than the subprime mortgages that were such an issue for banks in 2008 and 2009. However, the fact that the low interest loans are no longer performing well enough in order to offset the higher interest rates that now can be found in other investments or other loans that have been packaged, I think should be alarming. Now, this doesn't mean that there's going to be a catastrophic failure of lots of banks, but I think it is something that's important to look at. If you could get a 3% loan last year at this time, and now we're seeing loans at 6, 7, or 8%, there's a major difference not only in the cost to the consumer, but also in the cost for banks. Now, that doesn't mean investment in real estate is a bad idea right now. In a previous video, we've talked about how that's incorrect. Investing in real estate is still a good idea, but there is pressure on banks that are not making as much money off of loans in the single family sector that has caused tension, and First Republic is one of those banks. The second thing that we saw that sort of triggered the major bank failure is that First Republic showed $100 billion in lost deposits. Now, that's not lost earnings, that's lost deposits. Money that was in the bank from depositors. $100 billion moved out in the first quarter. And this is probably triggered by the bank failures of Silicon Valley Bank and Signature Bank, which happened in the past 6 months. This is causing individuals with high net of earnings and high, savings and deposits. They're wanting to be in more secured locations. And this leads to the third reason that First Republic, probably failed, is that First Republic was a highly niche or focused bank on high net worth clients. And those high net worth clients produced a significant number of depositors who were over the $250,000 FDIC secured asset in their bank. So, for example, if I'm a high net worth client and I've got $2 million in a CD or in a savings account, maybe I have, four or $500,000 in liquid assets and a interest checking account that I use to operate a small business, or I'm using it for a number of reasons that maybe somebody wealthy would. Anything over $250,000 is not secured. And for a lot of people, they probably were pulling money out and trying to diversify that money into several different banks or larger banks that they felt like were better diversified in their client base, or simply taking that money out of banks and putting it into something like a bond instead of a CD. So with that happening, you're seeing massive amounts of money flow out of these regional banks like Signature Bank, Silicon Valley Bank, and First Republic. This is causing tension on them because they're seeing this transfer of money. And being a niche bank for a long time was a good idea because it was giving you a specific target area. However, over the long term, when we saw Silicon Valley Bank and Signature Bank fail, individuals of high net worth are now saying, I don't want to be in a niche bank like First Republic because we feel like they have a higher exposure to collapse and the volatility of the current market. This brings me to a few things that I think are important to remember. Uh, we're being fear based in a lot of the decisions that are happening right now with the economy, and it's treading water right now, trying to stay out of dipping into a recession, and that's very difficult because a lot of individuals believe we are moving into a recession or are currently in one, and these regional banks are feeling the stress of that fear. So, couple things we need to know. These are the takeaways. Fear can play a major role in the market and can drive people out of investing or holding money in certain types of banks. Now, in no way do I believe that First Republic is going to be representative of maybe Bank of America, JP Morgan Chase. And we have seen regional banks recently in good positions to be able to take over banks. So, for example, First Citizens Bank actually took over Silicon Valley Bank and much of its depositors' money. And this is a good sign because First Citizens is a regional bank, but they are diversified with a lot of middle income families who have normal deposits under $250,000. So to say that regional banks as a whole are struggling is probably not true. It's those highly leveraged or highly dependent on high net worth or tech startups or ones that have extended themselves into these niches. They may be the ones that are actually, if anyone's in trouble, they may be the ones that are in more trouble. But we do see a lot of regional banks like First Citizens thriving and being able to absorb Silicon Valley Bank. So I don't think it's fair to say that regional banks are at risk. It's these individual banks that have focused narrowly on investments in depositors that aren't guaranteed. So anything over $250,000, there's a lot of fear about having that in a bank right now, especially in a small or regional bank. The second thing we want to notice is similarities of what have happened to banks in 2008, 2009, and historically, and the First Republic Bank. Now, what happens here is this. I think we can see a trend that when you see a specific area geographically failing, or you see similar customer bases or similar niches in the banking industry failing because of tension of interest rates or losses, you have to take note of that. So companies that were highly leveraged in a certain niche, for example, those companies like Lehman Brothers, Washington Mutual, other banks that had really high exposures to subprime niches of loans, we need to take note that that was a major issue. And there have been changes in the market to try to get away or regulate that. But now when we see customers that are over leveraged or over the deposit limit on a bank that is a regional bank or a smaller bank that's focused maybe on a specific sector, that should cause alarm and should make us wonder, is that a good idea? So if you're a bank and you primarily focus on Silicon Valley startups or tech startups, and that's your niche, and most of your exposure is over $250,000 in deposits, that may be a recipe for disaster when companies, get hesitant to want to deal with a small bank or a regional bank, or when those companies require high amounts of cash withdrawals quickly. And if you're leveraged highly on the tech industry and the tech industry takes a hit and all of a sudden they need to drain cash, that creates a run on the bank. They don't have enough cash on hand to meet the depositors' of needs. And remember that all banks are leveraged this way. They take depositors' money and then they use a large percentage of that to invest in securities or or interest-bearing accounts. Let's say government bonds, and they take the bond money and they use that to reinvest into the bank and bring cash flow in. They also do this with loans on homes and different packages of loans that they will purchase. They take depositors' money and they loan it out. And they take the interest and the profit off of those loans and they put it back into the bank. And that works fine as long as you don't have 100% of the people wanting their money out at the same time. Now, This is a challenge, but it isn't necessarily a reason for concern, because even if everybody in the country wanted to take their money out at the same time, they wouldn't do it because they really don't have anywhere to put that money or to spend that money. We can spend money at certain rates and we can save money at certain rates, but if we take all the money out at the same time and try to spend it, there's not going to be enough goods and there are not going to be enough investments really for us to put that money into. So there are reasonable rates at which banks can leverage depositors' money into other investments, and it be a very wise and even a conservative way. Jamie Dimon and JP Morgan Chase have been able to do this successfully and create the largest bank in the country and be in a position to still acquire banks that are struggling financially because they're overly leveraged in maybe one sector. The large banks have the ability still to leverage themselves and gain those, challenged banks or regional banks and incorporate them into their overall banking structure and system. And you may say, well, JP Morgan Chase is huge, and so would Bank of America and some of these other massive banks. First Citizens being able to do that recently with Silicon Valley Bank is probably a good sign, because they are not in any way of the size or category of a JP Morgan Chase, and yet they still were able to diversify themselves enough to be able to take on a Silicon Valley Bank or maybe a First Republic Bank type of company and move it into their depositor base. So I think that's probably a better thing. Now, the other thing that we should probably talk about then is this: the losses coming out of single family homes. If the losses of First Republic Bank are consistent with other banks, no matter whether they're small or large, if they're losing money on single family homes that were very low in interest rates, that could be a challenge across the board. So the question is that an isolated event, or are most banks being burdened by the low interest home loans that everybody either refinanced in or took out during the last 2 to 3 years? And that's an unknown. That's a point of question and something that we need to look at in the market thoroughly, because if those single family home loans were not profitable and causing hundreds of millions of dollars or billions of dollars of potential losses or unrealized losses to First Republic, is that happening in other places? Are the big banks losing money on low interest loans that they gave out over the past 2 to 3 years? I certainly hope not. And for everybody's sake, because there was such a large amount of refinancing and home buying during the last 3 years when home loans were low. And now that interest rates have jumped up. We don't want to see this sort of be a domino effect and see all of the banks now have hundreds of billions or trillions of dollars of loans now that are unprofitable for them. And that's somewhere where the Treasury and Federal Deposit and the Federal Reserve need to collaborate and figure out whether this is an isolated event. I would hope that it is, because I don't want to see the American economy go back to what it was in 2008 and 2009 with the amount of uncertainty that brought. But I do think that's a fair thing to look at and to keep track of. I am not saying, once again, I'm not saying that this is what is happening, but when you see, lots of news outlets confirming the fact that they had $100 billion in unrealized losses on single family home loans, we should perk our ears and take notice. That's a big number, and that's a huge statement to make. I will link down below of a couple sources that especially mention the unrealized losses of First Republic Bank. I'll make sure to link those in the bottom if you want to learn more and where those sources are coming from. But once again, I hope this has been helpful in helping you understand what happened with First Republic Bank and what we should take away from it. I am not an alarmist. I think the U.S. economy and its banking system is still in a good setting. It's these over leveraged banks into certain SKUs or niches that I think are finding challenge and are ultimately going to be stressed by a recessionary economic situation. So, once again, that's my recap of what's going on. So I don't want you to go out and bury money in the backyard because you're afraid of what has happened, but I do want you to know what is being said and why it may be of concern. So hopefully that helps. If you have questions or comments, certainly post them below. And I will look forward to the next time we speak on different financial subjects or leadership subjects. Hope you're doing well. Take care.